Hello, this is Connie Belden, and in this video, we're going to put together a traditional income statement and a contribution income statement. So let's assume the following information. We purchase t-shirts with an average cost of $2.50 per t-shirt. Then we resell them to our retail customers at an average price of $8 per t-shirt. We sold and delivered 4,000 t-shirts this month. So what I've done is I've marked out to the side because we do need to identify each one of our costs as a variable cost or a fixed cost. A fixed cost would be the same amount each month, no matter how many t-shirts we sell. So for example, rent on your apartment would be a fixed cost. It's the same amount each month, just like rent on a factory would be. A variable cost depends on how many units we sell. So a variable cost would be on a per unit basis. So let's start with our cost and identify them. First of all, we purchase the t-shirts at $2.50 per shirt. That is a variable cost, so I put VC out to the side because the total amount of that depends on how many t-shirts that we buy to resell. Going to our other expenses, advertising is $400 per month. That's a flat amount per month. So I identified it as a fixed cost. Sales, salaries, and commissions has a fixed component, a flat amount of $900 per month, plus a variable component, 10% of our sales. Therefore, this is actually referred to as a mixed cost. But a mixed cost is identified as having a fixed cost component and a variable cost component. So I mark that out to the side. Delivery of the t-shirts is $1 per t-shirt sold. So that's going to be a variable cost because it will vary depending on how many t-shirts we sell. Utilities is a flat amount of $100 per month and depreciation a flat amount of $200 per month. So I marked both of those to the side as fixed cost. Executive salaries are a flat amount of $2,700 per month. And insurance is a flat amount of $300 per month. So I marked both of those as fixed cost. Now the receptionist gets $1,000 per month plus 50 cents per t-shirt sold. That again would be another example of a mixed cost because it has both a fixed and a variable component to it. So I just marked both fixed and variable cost out to the side. Depreciation on the office equipment is $150 per month. That is a fixed amount. Now, let's go ahead and put together the traditional income statement. Any income statement begins with sales. We sold 4,000 t-shirts, and it said that we resell them at $8 each. So therefore, sales is $32,000. We purchased those t-shirts for $2.50 that we resell. And again, we bought 4,000 of them. So 4,000 times $2.50 means we paid $10,000 for those t-shirts. We call that cost of goods sold because that is the cost of the items that we are reselling. To get the gross margin, I will take $32,000 minus $10,000, leaves me with $22,000. Now we'll move on and identify our selling and administrative expenses, and we will keep them grouped as selling and then administrative. So we will go off the information here. So we will start with our advertising was a fixed amount of $400 per month. Now remember our sales, salaries, and commissions have a fixed part of $900 plus 10% of sales. We just calculated sales are $32,000. So to calculate this out, I would take 10% of sales, $32,000. That gives me $3,200. Then I would add the fixed component of $900 onto that, and that gives me $4,100. Okay, delivery for the t-shirts is 4,000 t-shirts at $1 per t-shirt. That would be $4,000. Utilities were a flat amount per month of $100, and depreciation was a fixed amount of $200. Now, when I add the selling expenses together, starting with the 400, 4,100, 4,000, 100, 200, I get total selling expenses of 8,800. Let's do our administrative. Executive salaries were a flat amount of 2,700, and insurance was a flat amount of 300. Now remember, the receptionist gets 50 cents per t-shirt sold. We sold 4,000 of them. So I would take 4,000 times 50 cents first. That's 2,000. Plus a fixed amount of 1,000. So that is $3,000. And depreciation on the office equipment was a flat amount of $150. Now I'm adding just my administrative, 2,700, 300, 3,000, 150. And my total administrative expenses are $6,150. Now I want to add all of my selling and administrative expenses together. So I will add the 8,800 that I came up with for selling expenses right here. And then 6,150 plus 6,150, the amount I came up with for administrative expenses. So my total selling and administrative expenses is $14,950. Now up here, I already took out my cost of goods sold, so I'm left with a gross margin of $22,000. To get my net operating income, I will take my gross margin of $22,000, subtract out my total selling and administrative of $14,950, and I get an operating income of $7,050. Okay, now we are going to put it into the contribution margin format income statement. The idea behind the contribution margin format income statement is to put all your variable expenses together. So for those that are mixed with both a fixed and a variable component, we're going to have to divide it out. And then put all your fixed expenses together. We're going to do it in total. And for the variable cost, we will also do it per t-shirt. Okay, so we're going back again to sales. Sales are the same. We sold 4,000 t-shirts at $8. That's going to be $32,000, or as given, $8 per t-shirt. Now, for my variable expenses, I will have my cost of goods sold, the cost to purchase those t-shirts from the manufacturer. So that's 4,000 t-shirts at $2.50. That's the same amount as previously, $10,000, $2.50 per t-shirt. Now, before I subtract anything, I want to get the rest of my variable expenses. Okay. If I go back and look at salaries and commissions have a fixed component of $900, so I will put that $900 in my fixed cost, and a variable component of 10% of sales. Okay, so let's go ahead and put that together. We are going to do the variable component first, which is 10% of sales, which is $32,000. So therefore, that is $3,200. Okay, and that would be 10% of the selling price. So the selling price is $8 times 10%. So per unit, that would be 80 cents. And again, we'll deal with the $900 fixed part in just a moment. For the delivery, it's $1 per t-shirt times 4,000 t-shirts, or $1 a t-shirt. Now again, the receptionist had both a fixed component of 1,000 plus 50 cents a unit. We'll come to the fixed part of 1,000 in a moment. The variable part is 4,000 times 50 cents, which would be $2,000, or 50 cents per t-shirt. Now I want to total my variable cost. 10,000 plus 3,200 plus 4,000 plus 2,000 gives me 19,200. I will total my variable cost per t-shirt of $2.50, 80 cents, $1, and 50 cents. So the variable cost per t-shirt is $4.80. Now instead of gross margin, because we're subtracting out variable expenses, we call this contribution margin. So I will take sales of $32,000 minus my total variable expenses of $19,200, and that gives me contribution margin of $12,800. I'll do the same per unit. I'll take the selling price per unit of $8 minus the variable cost per unit of $4.80, and that gives me $3.20. Now I will list the rest of my given fixed cost. It said it was $400 for advertising. Now remember, the sales salaries had a $900 component that was fixed, utilities $100 fixed, depreciation $200 fixed, executive salaries $2,700 fixed, insurance $300 fixed, and then remember the receptionist was a mixed cost with $1,000 of it being fixed, and depreciation on the office equipment was fixed at $150. Now I will add all of my fixed costs together, and I'm just doing it in total, not per unit, and that gives me $5,750. I now want to take my contribution margin, $12,800, minus my fixed cost of $5,750, and that gives me the same net operating income of $7,050. Now, the reason why it is the same is because we didn't have any beginning or ending inventory. We bought $4,000, we sold $4,000. It would be different, we'll get to that later on, if that does have some beginning or ending inventory. Thank you very much.